Buddy, thanks for joining in. My name is Jennifer Cuartas, National Director with Exertis Financial Partners. I've had a lot of people reaching out, wanting information on exactly how do we help people. I am constantly dropping posts about preparing yourselves and your loved ones for pretty much whatever life might throw at you. Financial strategies that'll help you through all the different stages of your life, from getting married to having babies, buying a home, sending your kids off to college, having grandchildren, retiring. Best part is retiring tax-free, right? Traveling, having money to be able to live on, leave behind a legacy that's something more than memories. Being able to have emergency funds and pay bills during pandemics and things like that, right? So there's three major financial tragedies that happen in people's lives. Every single product that I work with helps to prevent the financial tragedy, the avalanche that falls after you are hit with one of these scenarios. And here they are, and I'll go into details on them in just a second. The first one is that people get sick. They can't work anymore, can't provide an income, critical, chronic, terminal illnesses, life-changing. I know it's kind of funny to think about this, though, is that living too long could be an actual problem, but we are having 10,000 people every single day that are shifting from being a working individual to retiring 65 plus years old, and they're finding that they are really unprepared. And so, yes, it becomes a financial tragedy. And the third one, obviously the saddest one to talk about, but the most important, is that life doesn't always play by the rules that we set out or even designed. Our plan, our goals don't always happen. And sometimes either we or a loved one die too soon, leaving behind financial pieces to pick up, mortgages to pay, kids to still send to school. There's a lot involved in all of these scenarios. So what's so important is to protect those who depend on us, especially for myself, like as a mommy, I look at my kids and I'm like, I will do anything to protect them, right? Whether I'm here or I'm not here, I want to make sure that I have that ability. And our greatest asset that we have in our lifetimes is being able to earn an income. But what if you couldn't anymore? Imagine if your family's financial reality just completely shifted. You couldn't provide for them because you got sick, because you're terminally ill, because you got into an accident and now you're disabled. There's so many situations that can happen. And I can tell you right now, when you get the news that you have a serious illness, the last thing that you want to think about and worry about is how you're going to feed your family, how you're going to keep the lights on. That becomes a stress in itself. So what I want to share with you now is how you can provide that peace of mind moving forward so that you're not in that kind of situation, right? So good problem to have, but problem nonetheless. Americans are living a lot longer, and we are experiencing a time frame where we've got all these baby boomers that unfortunately got caught up in all of the, I would say the last 30, 40 years of inflation, where paychecks didn't keep up, and we were living in households where you either have to have a multiple job or multiple people working. And it's very, very important, more now than ever, to be sure that you save properly for retirement. So before we continue, I want you to think about something just in the back of your mind. If you right now had to decide whether or not you have a secure retirement, what does it look like for you? Are you 100% sure, confident that you will have a great retirement? Or do you have some doubts, And I think about people like my mother-in-law. She's 91, you guys. I want to be like a sea turtle. I want to live to I'm like 150, no lie. But the number one fear of baby boomers right now is that they're outliving their money. My mother-in-law is 91. She is a I'm sorry, she's 90, she's about to turn 91. But I think about people like her, retire at 65 and you live until you're 95. I mean, that's 30 years of income. 30 years of just paying for survival is going to be expensive. Water and power and food. And what about actually enjoying life? That too. So it is a big concern. Most people who I talk to, most people who have reached out to financial advisors and coaches and have this fear, this concern of what's going to happen, here's what we find out. They're 50, 55 years old. They've got $8,000 in the bank. $8,000, if you're still paying a mortgage, how far is that going to take you? What, 4 months? 3 months? Maybe 5 or 6 at the most? But you're planning on retiring pretty quickly in 5, 10 years, right? There's a lot of years to make up for. So how do you do that if you don't have a lot of money to make it happen? Because if you did, you wouldn't be in that situation, right? So let's back up a little bit. Before we can talk about solutions, we have to talk about the problems. There's 4 major things that actually contribute to the retirement problem that we've got today. One is debt. Debt is huge because we have been brought up in a society where we all deal with it on some level. We usually start out in college buying books, buying what we need with credit cards. True story. First time I ever got myself into debt was the day I enrolled to college, and they had this little table set up. And they said, come over here and get your first credit card and go over to the school bookstore and you can pay over time. And I destroyed my credit with that credit card because I maxed it out in that store. And when you're a college student, you're not working as much as somebody who's not in college. And so I was stuck with a car loan, credit cards, student loans, and then still trying to pay my bills because I had an apartment. I was living on my own. And you see, it starts there. And then it just starts this trail that follows you, right? But we have medical bills and mortgages and family expenses, and often that follows people into their retirement ages. Now we've got market exposure. Most retirement accounts, unfortunately, are based on the stock market and the success of it. 99% of Americans go based off of what their job tells them is right for their retirement. I'm sorry, but if you work for a plumber who gave you a retirement account, take their advice on plumbing. Don't take their advice on your finances in 30 years. And that goes for any job. If you work for a grocery store, same thing. Talk to them about buying and purchasing food, but don't talk to them about your finances in 30 years from now and hope and pray that they made the right decision for you and they're not a financial advisor, okay? The biggest mistake I see that people make is that not only do they not sit down with a financial advisor and they just go with the flow, whatever the public and the general population says, that's what we do, but they also bank their entire retirement on the backs of a company that may or may not be there in 10 or 15 or 20 years. So have your retirement as an addition to what you prepared for yourself, but not in replacement of, okay? And for those of you who are scoffing at what I just said and at this video and saying, but even if my job disappears, the retirement will still be there. Well, good luck living off of a retirement you had for 5 or 10 years. And now go and find another company that's going to give it to you because now you have to work an additional 10 years past what you were planning on to get your full retirement. So, yes, it's a huge problem. A big chunk of our money also goes out to taxes. A lot of people don't realize that there's actually a way to avoid that. And I'll go into that here in just a little bit. Given the uptick in what's been going on in the recent government spending, the possibility of an increase in personal income taxes to finance these expenses is one that's not too far off. So unfortunately, that becomes a big problem, right? And income has not kept up with inflation. And too many people are living at the top of their means, not because they even want to, but because they have no choice and they have to. And one of these incomes goes away and there becomes a problem, right? So people need to learn how to make money work harder for them than they work for it, because sometimes life shows up. And every 43 seconds, somebody in this country is having a heart attack. Every 70 seconds, somebody is being diagnosed with a stroke. And every 40 seconds, there's another person being told that they have cancer. And these are very scary numbers. A lot of times, these situations, they stop our life as we know it. You could fight cancer for 5 years, 10 years, 15 years, 20 years. My sister-in-law has had cancer for 20 years, and it's still a struggle for her. She's still having, that's 20 years of medical bills, you guys. 20 years. Now, they told her she was going to have 6 months to live, so she could definitely beat all the odds. But most people don't have 20 years of income to be able to fight something like that. Strokes are the #1 cause of disability, and heart attacks could either be disabling or you could pass away. And so I want you to ask yourself a couple of things and really think about it. I don't care what the answers are. I don't want them. I want you to care what the answers are, and you need to know what they are. If you were to die right now, would your family be able to keep the lifestyle that they have? Do you have enough money to retire on if you live a really long time? What is your retirement vehicle? What's your plan? And what's your backup plan if that one doesn't play out? And what happens if you get sick? Do you have access to funds in the event that you have a major illness? And if your answers scare you, what's the solution? You got to change something. There's a question that I ask to every single person that I talk to, and that question is, if you had a life or death situation right now and you had to go to the bank, put in your ATM card, pull 100% of the money out, how many years can you live on that money? How many years can you live on that money? Years, not days, weeks, months, years. Because you plan on living years, right? Years. And if it was a life or death situation, how big of a problem does that money in the bank that you have right now, how big of a problem does it solve? And these are very important questions to need the answers to. But the answer to all of them, everything we've talked about so far, would be a life insurance policy that you can use while you are still alive. It doesn't have to motivate you to die to use it. And that's the problem with the mentality of what people think about life insurance. It can be used for your life, your living years, not just for when you die. And so let's talk about that for a second. Okay, so we here at Exertis Financial Partners, we follow something called the I Quadrant. All right, what this I Quadrant is designed to do is to make your dollar work 4 times harder for you. Okay, now it's going to hit on a couple of areas in your life. It provides an instant estate. It gives an index strategy. It provides income for the rest of your life. And money if you get sick for an illness. So I'm going to break down what each of these do real quick. Instant estate means instant net worth, and we use a term called DIMER. Basically, what this does is in the event that something happens to you, it makes sure that your debt is paid, replaces your income for the next couple of years, so that if it's you that passes away, your family can grieve. They can still pay the bills, though, while they do it and create a new normal. But maybe it's not you that passes away. Maybe it's your spouse. Well, how does that affect you? Maybe it's you that needs that money, that income. Especially if it's only a one income household, because I can tell you this, regardless of who makes that one income and regardless of who passes away, no one's working. Not for a while. So that income is going to be really important, especially if you have a rent bill or a monthly mortgage check that has to go out. You won't anymore. This policy will do one of two things: buy the equivalent of what you're renting now, or pay off the mortgage in the place that you currently live. That way, you don't have to have that debt hanging over your head. Okay? It's not about getting rich or having all these great things because someone died for you. What it is safety and security and that last love letter that you're leaving behind for your family to make sure that they're taken care of, even though you can't take care of them. It provides for education for your children. I make sure, if you sit down and you talk to me, I can't vouch for anybody else you talk to in any other company or what have you, but I make sure there's enough money so that what if you and your husband or your wife both died at the same time in a car accident? Even if neither one of you are here, your kids don't suffer. They don't become a financial burden on anybody. They can still get new clothes, they still get fed, they still get to go to college, or even start a business if they decided they're not the college type. You will still be able to take care of your kids and it's not a concern. Yet, what happens in most of people's situations, 1 out of every 4 people have proper insurance. That leaves 3/4 of everybody in this country, 3/4 of people, 3/4 of the people in your household or your family will end up losing every single thing they've got in less than a year. If somebody gets sick, disabled, or dies, and is a financial provider for that family, for that household. So it makes sure that your responsibilities as a key member of your family are still taken care of. So important, so important. So index strategy is how we grow our money. We have to make sure our money is constantly growing. We're going to get to a point in our life where we're not going to be able to work anymore. So we have to be able to utilize the money that we have, make it work for us, than us working harder for it. And that's the way that we're always taught. See, these are tools and strategies that the wealthy have been using for over 100 years. If you didn't hear about them, it's just because you didn't sit down with a financial advisor or coach and become educated. But these are not new concepts. They say that the rich get richer because they have money, right? You got to have money to make more money. Well, how do you get more money to make more money? You make your money work harder for you. So through the S&P markets, we actually help you to have great market potential and protect your market so that it's not volatile like your current retirement might be, all tied up in the stock market. What happens when the stock market plummets? You see these dips? We don't have that here. Instead of it dipping at those scary points, it'll just stay the same. You don't lose any money. Which brings us to income for life. This is when we refer to what's called a tax-free retirement. So the best way to explain it to you is that we've got these 3 buckets, okay? The first bucket is what focuses on like your normal investment accounts, your bank account. Your bank account, any interest that they give you, you're being taxed on it like it's income. I mean, a $10, if you put $100,000 in the bank and you get a $10 interest payment to you, they're going to tax you on it, and you only actually get 7 of it left. I mean, that's just crazy, right? Then I call this second bucket our bucket of illusions, because here's what happens in this bucket. We go and we get a job, and we listen to our boss, who tells us, talk to the HR lady, who sets you up a 401k. And they do this wonderful thing and they match every dollar that you put in. And it's pre-tax, right? Money goes in, you don't get taxed on it now. It's tax deferred. You get taxed on it later, but you're still being taxed on it. We all think it's a great idea. This is why we call it the bucket of illusions. So I'm going to ask you one question to sum this up real quick. What do taxes do every year? They go up. They increase, right? Every year. So you work for that job for 30 or 40 years and you just spent 30 or 40 years allowing the taxes to go up and up and up. Wouldn't you have rathered to pay the taxes before that happened? If you had the option? Which brings us to the last bucket. This is the only bucket I play in. Okay? This bucket is a super high cash value life insurance plan that will provide income to you as long as you have a policy in place for the rest of your life, and you get to retire from it tax free. So, bucket 1, not the way to go. Bucket 2, bucket of illusions. There's better ways. So we're going to focus on bucket number 3. And here's kind of a little bit of an explanation about if you're questioning your 401k, your 403b, right? The difference between a tax-deferred and a tax-preferred method, and if you want to, I can sit you down and we can actually talk numbers. But here's the easiest way to explain it. Your pre-tax dollars are the seed. Would you rather pay early on, when it's low, when it's little, when it's more manageable, or do you want to wait till your farm explodes, the seeds produce the harvest, it grows and grows and grows, it's out of control without help of somebody else to help steer it back in and get it back under control and do what they need to do to maintain that farm? That harvest is wild, right? It's big, it's tall, it's overgrown. The seed is still low to the ground and very, very manageable. Which do you want to pay taxes on? Something that's small and manageable, or something way big and overgrown and out of control? That's the difference between your 401k and your high cash value plan that is tax preferred. So that brings us to the income for life and how this piece of it works. So inside of your policy, we have 2 pieces, okay? This is one particular policy that I want to talk about. Now, this policy has 2 pieces to it. One, which is your death benefit. That is, life doesn't play fair. Your debts are paid. Your mortgage is taken care of. Kids are taken care of. We talked about that a little bit, right? Family can lay you to rest, cremate you, whatever you want to be done. You can even make sure there's enough money in there to fly your family in to wherever you want, your final resting place to be. There will be money there to pay the bills so that your family can grieve and all of that. That is the worst of case of scenarios, right? Passing away and needing to use that. But I mentioned that we have built into our policies the ability to use it while you're still living, to give you a better life, to prepare for emergencies. That's where the cash value piece of this policy comes in play. Now, this is considered very different than any other type of a financial vehicle out there, okay? And I'm going to use your bank account as an example because I know that you can probably relate with this piece of it, okay? Now, the insurance company has what's called a general fund, all right? Now, this general fund works in conjunction with your cash value that they use as collateral. So let's say you take $10,000, you put it in your bank account, and you go into the bank the next day, and you say, I'd like a $10,000 loan to buy a car. What are they going to do? They're going to charge you interest for as long as you have that loan out. And they're generally making, a bank is a business, okay? It's not a government entity. A lot of people get this confused and twisted a little bit in their mind. Now, even though you put that $10,000 in before, they're going to charge you a percentage. 8 to 24%. Doesn't matter, you just gave them 10 grand yesterday. They're going to turn that 10 grand around and say, thank you very much. Here's a couple of cents as a thank you, as interest. Thank you very much. Fraction of 1%. And they're going to turn around and make 7% off of that money that you put in there. They're going to make 70 grand off of what they're charging you and everybody else in interest. So how do you become the bank? How do you avoid this from happening, right? Just because it's the only way that you know to buy a car or expand a business or to take a loan doesn't mean it's the only way that's out there. It's just your limited knowledge keeping you in that box. So it's time to break free of that box, okay? So inside of your cash value, every single month, it's going to earn. The particular policy I'm talking about has been earning 6.62% interest. So now you see that you could be paid the same way that your bank is. By that money sitting there, it's going to continue to grow. But guess what it does differently than your bank does? When you take this money out, you can choose to either pay it back or not. You see that little red thing on the death benefit that just popped up and says pay off loan? If you have not paid it off at the time that you pass away, it'll just come off of your death benefit. Again, not becoming a burden onto your family. My favorite piece of this type of policy is that, remember I mentioned about your bank. You put that $10,000 in and they're going to say thank you and give you like a little couple cents. Instead, you decide, you know what, I don't want to take their interest. I'm going to take my 10 grand back out. I'm going to go buy whatever I need, my car, whatever I need to buy with that 10 grand, right? I'm going to go do that. When you take that 10 grand out, are they still going to say thank you and give you a couple of cents? No. But guess what your income for life policy does? Even though you took that 10 grand out, 20 grand out, 100 grand out, doesn't matter how much you took out. Whatever's available in there, you have access to it. You took it out. You borrowed it. It's yours. You're allowed to do that at any time. You don't have to tell them what it's for. You don't have to ask. All you gotta do is call them up and say, hey, I'd like this amount of money. Is it available? Yes? Great. And that goes into your bank account within the next couple of days, or they send you a check or however you want to get it. All right? But here's the thing. Because it's a non-direct recognition loan, and they know that if you die, there's enough money to cover that loan amount in the death benefit to pay it back. Here's what they do. They pretend that that money's still sitting there at 10 grand, 20 grand, 100 grand, whatever grand, okay? And they continue to pay you that 6.62% interest as if you never took it out. Imagine that. Now, you have the cash to live on. You can get better treatments. You can buy things with it. You can expand a business. You can do whatever you want. Take a vacation. Don't care. Leave it aside for retirement. Up to you. But what really matters in this policy is living benefits. Living benefits is huge. Because how many people do you know, have you read about, seen commercials on TV, all the medications for people who have had heart attacks, strokes, cancer, cystic fibrosis, gone blind, have a brain injury, develop Lou Gehrig's disease, ALS, have organ transplants, end up in end-stage renal failure, end up having AIDS. And, there's just so many situations that could be defined as critical illness. Basically, what this means is that you went to the doctor, you were diagnosed with a condition that the doctor says to you, you need treatment. And if you don't get it, you're going to pass away in the next 6 months. Now, you could live another 30 or 40 years if you got the treatment. Doesn't matter. What triggers the payment to you, up to 90% of whatever the death benefit is in your policy. So if it's 100 grand, you're getting 90 grand. If your death benefit's $1 million, you're getting 900 grand. Your death benefit will be the determining factor of how much money you get for critical illness, chronic illness, terminal illness, okay? So they say 6 months, you'll die if you don't get this treatment. That's what triggers this payment going out to you. The second thing is chronic illness. Chronic illness is somebody who, for whatever reason, they cannot bathe themselves, they can't dress themselves, they can't feed themselves. Now, this doesn't have to be a permanent situation, but it has to be at least 2 of the 6 activities of daily living are unable to be performed without help. So can't just be 1, it's got to be 2 or more. And it has to be a period lasting of at least 90 days or longer. Okay? And it's got to come from your doctor. They're going to confirm this with a doctor. Some companies do also consider cognitive impairment as qualifying illness. If that's a concern to you, it's something we can talk about. Now, terminal illness hits home for me because I watched 6 family members who looked, acted, and otherwise appeared healthy go to the doctor, find out that they had cancer, and I watched, 4 of them pass away and didn't even have benefits. This is before I got into this industry. It's actually why I'm in this industry, okay? Because I didn't realize that what happens, financially to a family that is left behind to pick up the pieces. But not only that, once you get that diagnosis, it's too late to put coverage in place. It's like totaling a car and then being like, hey, can I get some car insurance and a replacement value on that? We're playing Russian roulette with our health, and we all think we're going to get old and we're going to live to 150 and we're going to be like sea turtles. And unfortunately, life doesn't always play that way. But what I also saw happen was I watched my grandmother with stage 4 lung cancer that spread to her brain work a job that she wasn't healthy enough to even do and used to hide and turn the lights off and make customers think that nobody was there because she needed to collect a paycheck just to be able to keep her lights on, let alone pay for her treatments, just to go to the doctor for him to offer something for her to even decline a treatment. And it's sad. You don't want to see your family go through that. I got to the point where I was so upset, I called her job and was like, please fire her. Do her a favor. You are not doing this woman any favors right now. She worked until 2 weeks before she died. 2 weeks. Never even got to enjoy life. And she wasn't that old. She really wasn't that old. And so I know a lot of you, this might hit home, and you might be feeling that. And the thing is that you need to get something in place because you get that scratch in the back of your throat. You wake up with a cough. You got some aches and pains that have been around for a while, and you assume that it's because you're getting older, and then you find out that wasn't the case, that you had something terminal. So if a doctor tells you you've been diagnosed with anything that's going to cause a result of death within the next 6 to 24 months, in their opinion, okay, even if you use the money to get some experimental treatment and you outlive it like my sister-in-law did, but a doctor certifies that this is your scenario, then they'll fully accelerate the death benefit. And then you can choose, take all of it now or leave a portion behind for your beneficiaries. So I'm going to give you 2 different scenarios of, I'm going to give you 2 different scenarios of a case study. Okay, I'm going to use the same person, 2 different plan options. Okay, now this is just for you to get an idea of what to expect. We have policies for every budget, every situation. Sometimes the policy we want, the policy we need, and the policy we can actually afford are 3 completely different things. What I try to do is talk to you, have a serious conversation about what do you need? What is it that ultimately you would like to have? But realistically, where do we start? Maybe you can get everything that you want and need, or maybe we need to start small and then increase later on, okay? It always can be worked out. So the key, though, is that life insurance is based on a couple of factors. Age is a major one. Health is the most detrimental one. You have to put a policy in place before you get diagnosed with something big. Okay, it's just the way it is. And if you waited, people like to get angry at me, like I chose this for them or something. But it's not your agent's fault if you chose to wait until you were 60 to have a conversation and you've had 2 heart attacks and a couple of surgeries, and most carriers are telling you that you're not able to be covered because life insurance is like a leaky roof. The longer you wait, the more damage happens and the more expensive it gets. It's just the way that it is. All right? So if you're young and you're healthy and you're thinking, oh, I don't need a policy because I'm young and I'm healthy. Well, think about when you bought a brand new vehicle. It didn't even have a mile on it when you drove it off the car lot. What did they make you do right before you left? Provide proof of insurance. Well, why do you need proof of insurance on something that's brand spanking new? No wear and tear, nothing wrong with it. It's not going to get in an accident today. Well, do a Google search on how many people leave the car lot and wreck their car in the first day, 2 days, 3 days after they purchase a vehicle. We do the same thing with our health. We play Russian roulette. Because you're healthy and happy and young today, you think that tomorrow you're not going to get a diagnosis. I thought that about me too. But here we are. Okay? So here's just an example. I'll go through these real quick. This covers all 4 of the I Quadrant categories that we discussed. Having an instant estate, income for the rest of your life, income for if you get sick, and your index strategy, which is, your money growing. This particular person's a 30-year-old female. She's a non-tobacco user. That's what NT stands for. And she wants to only pay until she's 65 years old. And after 65, she wants to be covered for the rest of her life, but she doesn't want to have to pay bills anymore once she's considered retired, right? Like that's the point where you want to start reducing all of that. So she plans to retire when she's 65. Day one, her instant estate is at $157,000. Day one. Now, her income for life, I said she's retiring when she's 65, right? So she's got 35 years. For the next 35 years, she's going to pay $100 into this policy. And in return, the policy then is going to turn around and pay her. Now, between 66 years old and 100 years old, so for the next 35 years, this policy will pay out $334,000 to her. Now, that average is about $9,500 a year. But if she gets chronically ill, critically ill, or terminally ill, this policy is going to pay out just over $100,000 in any of those scenarios. Because her instant estate is $157,000, and it's about 90% of your instant estate that's going to actually pay out, okay? So that's where her chronic, critical, and terminal illness comes from. And even with all of this, she still has a cash value of just shy of $100,000 that she can use for whatever she wants in her life. We recommend that you use that for your retirement, but you could use it for whatever you want. Want to buy a vehicle? Well, buy one. And then you're not paying interest to, a bank or whoever. You want to expand your business? You want to put money down on a house? I mean, want to go take your family on a memorable vacation before you become an empty nester? I mean, whatever you want to do. Send the kids to college, buy them a car when they turn 16. I mean, so much for $100 a month because she made that decision early enough in her life. But let's put a different scenario. There's a lot of people who I talk to that think that they're making really good financial decisions, right? They'll pay a little bit extra every month on their credit card. They'll pay an extra car payment when they can afford it. They'll round up to the next 100 their mortgage payment, or their credit card bills or whatever. Sometimes they're putting money into a 401k or even into a savings account. That's what was being thought of when we put this scenario into place. A lot of times people are budgeting $300, $400, $500 a month that are actually dollars that are being used inefficiently, even though they think that it's making a huge impact, but it's still being eat up by interest and other factors, right? So we helped this girl to take the same amount of money that she was using in other avenues where she wasn't gaining much from it. Her $500 a month that was going into her bank account, she's not even getting enough interest from her bank to even remember ever getting any. So, do you remember getting interest from your bank? I mean, how much have you gotten? On average, a bank, regardless of what you're giving to them, they're taking that money and they're turning around and they're loaning it out to other people to buy their cars, to charge them interest, 3% to 24%, and wherever you fall in that range, right? And then they make about $7 on average for every $1 that any of their customers put into their bank account, and then they turn around and pay you pennies on it. Well, this particular policy we're talking about teaches you to be the bank. You're being your own bank. We call it BYOB, okay? Be your own bank, because you can. And the only reason why you're not is because somebody just never taught you how to do it. That's a conversation for another day. But when you take that same money that you're already budgeting to put into savings or spending in inefficient dollars, and you're barely making any headway, I'm showing people how to have a day one instant estate of over 800 grand. If you get sick, you've got 600 grand, 500 grand to be able to pay for your critical illness, chronic illness, terminal illness. Think about the level of medical care you could get with that kind of money. The difference between this plan and the other one, same age, same person, same scenario, just that instead of $100, it's $500. She's now able to get, instead of a $9,500 yearly paycheck, now she's making $53,000 a year every year, and she ain't working anymore. For 35 years. She's going to collect $1.8 million from this insurance company just because she made it to retirement, kept her account in place, and had the proper things set up before she needed it. And then her cash value, the look of that changes completely. She gets about 5.5 times more money than what she would have on the other plan. So we're looking at just shy of 550 grand. To be able to do with whatever she wants, on top of the money that's paying her out every year to keep her bills paid. So this is just a cross comparison of the two policies. It's kind of, you can look at it and it's kind of self-explanatory, but at the very bottom is where I want to bring your attention, where it says what her premiums were over the years. A lot of times people think, in their perspective, $500 a month, I mean, that's a lot. But a lot of you guys are signing up for $500 a month for a car that's only going to last you 3 years before you go buy another one. And you're willingly doing that and paying insurance on top of it. So you're like going car broke at $600, $700, $800 a month. But this girl, instead of paying a car payment for $500 a month, she spent $500 a month and then used the cash value to buy her car. So here's what it looks like overall. The 35 years that she pays in, if she does it at $100 a month, she's paying out 42 grand to the insurance company. $500 a month, she's paying out $210,000 to the insurance company. But here's the thing. Just look at the income for life. If that's the only piece out of this that you get, which it's not because the policy covers you to your 121, you're going to get sick. You're going to die. You're going to die before you're 120, okay? And you're going to need money to live on for the rest of your life. She took, in the first scenario, $42,000 and flipped it into 330 grand. In the other scenario, she took $210,000 and flipped it into 1.8 grand. And that's not even including if she gets sick or dies, right? That's just money to live on. That's just money to motivate you to live better. Most insurance agents don't talk about the cost versus the benefit. You can't afford not to do this. And I used $100 and $500 as just gauging points, but there are policies for every single situation, every single budget, every single scenario. I've done policies from $13 a month to $2,300 a month. So it's all just based around what you want, what you need, and what you can afford. The thing is that there is no better time than right now to have this conversation. If you haven't had it yet, you're making decisions based on uninformed information. To make the most informed decisions, you have to have the right education. So let's at least have a conversation, sit down and talk about it, and decide, from there, once you have all of the info, all of the details, whether or not you see value in a plan designed around you and your family. Again, Jennifer Cuartas, National Director, Exertis Financial Partners. Love to work with you. Thank you so much for taking the time to watch the video. Make it a super fantastic day, and I look forward to hearing from you soon. Bye now.